You do not want to miss this episode. Christina and I are going to break down a registered education savings plan, an RESP, versus an infinite banking policy on a child. Which is better? And if you stick around to the end, we're going to show you the actual math. Hi, everyone. Welcome to Control and Compound with Darren Mitchell. I'm your host, and joining me today, as always, Christina Wyatt, wealth coach at Control and Compound. Christina, how you doing?
Hey, Darren. I am doing great. How are you doing today?
I'm doing fantastic. Pretty excited about this. We get a lot of questions from listeners and from clients. Which one is better? So where are we going to start, Christina?
Well, before we get started, I just want to remind everybody, if you're listening on your favorite podcast platform, please subscribe and leave that 5-star review. If you're watching on YouTube, make sure you like, subscribe, and hit the bell button so you never miss new content. And don't forget to follow us on TikTok and Instagram at Control and Compound.
Okay. Thanks, Christina. So we're going to talk about RESP, or Registered Education Savings Plan. But let's kind of step back and really, I like asking the question, what are you trying to do for your children? Fair question?
Yeah. So what are you trying to achieve with this?
What are you trying to achieve? You know, is it to help them with their school, or is it help them financially? If your child came to you at 18 and said, listen, I want to do a carpenter program, get into real estate and the renovation business and become an investor, are you going to, disown your child for that because they didn't go to university? I'd be excited. But really, what is the goal? I think the goal should be to help your child financially in whatever it is they choose to do. Okay? You're just trying to give your kids a leg up. Versus an RESP. What can you use an RESP for, Christina?
Education. So it is, deemed the education or out there. A lot of people believe it to be the only education savings tool out there for your children.
Yeah, and we're gonna break down the sort of the pros and cons of the different strategies. But one of the big things we always talk to clients about is you got to think generationally. So kids, grandkids, future generations. Think long term. That's great, but let's go back to the basics, Christina. And there's really only two ways to pay for something, or most people pay for things. Right? They save, pay cash, or they go into debt and they pay it off. So we call that the debtor or the saver. And those are the two most common ways to pay for things. What's the third way that we love, Christina?
Yeah. So including university, right? So that's exactly how kids are doing it. They're either saving and paying cash, or they're going into debt and they're paying it back. There's only two ways to do it. And that RESP method is the save, pay cash way, right? So the save, pay cash. The infinite banking policy is what we call the wealth creator. So it is different. It's on a different level. It's not the same as the other two. It's an alternative way to saving for your kids' education plan that we believe has a lot more benefits than just the education side of things. So when looking at the RESP, and I think we should get into exactly what an RESP is and how they work and the benefits of them versus the infinite banking policy. But the wealth creator part is huge, because this is not just what did I say the other day? A one-trick pony. It's not a one-trick pony. The infinite banking policy is going to do more than just the education side, and we're going to keep our wealth uninterrupted, compounding. And today we're going to talk about, kind of go into detail on exactly how it's going to be able to do that, right?
Yeah. And I mean, we love the snowball analogy. We use it all the time, but I think it's fitting here is, do you want to help your kids for a 1 to 4 year period in university, or do you want to help your kids for the next 100+ years and your future grandkids? Because that's really, we're talking about staying on that exponential growth curve. So when you're rolling that snowball, on the RESP analogy, you roll the snowball, you get it up, they turn 18, 20, whatever, and then you smash the snowball. And then if that child or anyone else in the family wants to start saving, they start from scratch. Versus you stay on that exponential growth curve. Your infinite banking policy continues to compound literally for the next 100+ years, hopefully, and you can pay those loans back, continue on the compound interest curve. You're literally giving your kids a 20-year head start on the compound interest curve. And we all know the the value of being invested long term. So the numbers I think are quite staggering long term, and we're going to break all that down today. But Christina, you mentioned what is an RESP, Registered Education Savings Plan. Let's just kind of give the highlights of the parameters of how an RESP works.
Yeah, for sure. So RESPs, why have we been taught to use them for education savings plans? Lots of people are using them, and to be out front, they are, from an education savings tool, they are good, right? Because there's a couple benefits that you get with them. So with the RESP, it is a government run program, right? So it's just like your RRSP, but RESP registered, right? So through the government, what happens is you make deposits into this account each month or year, whatever you want to do. And the government is going to provide you with a grant for your deposit. So you get 20% on what you've deposited each year for that grant, up to a max of $500 a year. So what you see a lot of people do is they'll put the $2,500 in each year to get that $500 maximum grant. And that's the bone. That's why people do it, right? For that grant. That is why they're doing it. Now there is a maximum grant available of $7,200. So let's say you start from the day they're born, you really got about 14 and a half years with those grant funds coming in. Then they're going to stop. A lot of people do tend to believe that these are completely tax-free, which they're not. But the strategy is when your student is withdrawing them, they're in a very low tax bracket as a student. So they would be paying tax on the interest. So there's a couple different components. By the time you get to school, you have the contributions that you've made into it. You have the grants that were given by the government. And then you have your interest earned. Because what a lot of people are doing with these RESPs is they are putting them in the stock market. And there's lots of volatility in the stock market. You don't have to. You can just take an high interest savings account and whatnot. But a lot of people will use the strategy of putting those funds in the stock market. So you have that interest component when it's time to go to school. So the contributions can obviously be taken tax-free out, along with the grants, the interest. You're going to have some taxes there. Although again, student, if you're using this strategy for the education, you're completely fine to use it that way. What happens though, if your child does not go to school, is that you are able to take the contributions back tax-free, the grants. So that $7,200 is going to go right back to the government. So that's gone. And then you're going to pay full tax on the interest returns that you've had there. So using it for school can be beneficial to get that $7,200, but outside of that, there are a couple downsides with the RESP as well. If we don't know if every kid out there is going to go to university, right? And you can run into some trouble there.
Yeah. So what, as a parent or a grandparent that started an RESP, if the child doesn't go to a higher education place that qualifies under the RESP, what can I do with the money then? Can I just take it all out and spend it tax free? What has to happen if my child doesn't go to university or college or some approved program? What happens to that money in there?
Yeah, so like I said, you get the contributions that you deposited, you can take those back, right? That was after tax money. So you can take that out tax free. The grant is going back to the government, so you're not going to have access to that, and you're going to pay taxes on that interest. There are some rules in some situations where sometimes you can roll them into an RSP, another type of registered plan, if there's a disability, things like that. We won't go into the weeds on it, but typically you're going to pay tax on anything you've earned, and you're going to give all those 7,200 grants back, and you are going to get to take out your money tax-free. But the entire time, again, we have to remember we haven't had access to those funds either the entire time that they were in there.
So you're saying I can take it from a minimum security prison into a maximum security prison by rolling it from an RESP to an RESP to an RRSP? No, I'm joking. But again, it reminds me of the story years ago. I was on the benefit side, and we had pensions and group RSPs, and we had this thing, if we could find a wealthy professional, and we could start a group RSP literally for just him and his spouse, and the fees really down. And I remember going in to see this big successful business guy, and I'm like, oh man, we can put in a group RSP just for you and your wife, and the fees and all this. And the guy just kind of smiled at me and laughed, and he goes, You want me to put my money in a government run program and that's going to help me become wealthy? And he just kind of chuckled. And I was like, uh, thanks for your time. But I mean, I'm not a fan of the RSPs for the entrepreneur and the real estate investor. RESP, similar, okay? Not as bad, but similar, because that money effectively, to me, is really in jail for a period of time. And I'll tell you my RESP story. I have an RESP for my kids. You know, I don't want to say I didn't know any better, but if I go back in time, I do it a little differently. About 20 years ago, I started an RESP before my daughter was even born. My son was like 2, and I put this massive lump sum in. I had a really big year that year, and I'm like, I'm the dad of the century. I'm going to put in this large lump sum. And looking back, that money's been in prison for 20 years. What if I had taken that money and bought a duplex, bought a fourplex, put it in an infinite banking policy, whatever it was? How many times could I have used that money over the last 20 years? So again, I'm not saying they're awful. I'm just saying you got to know the restrictions and the cons as well. Because to me, locking that money up with only allowing it to do one job for the next 20, 24 years is a con to me. I like my money in more than one place at the same time, doing multiple jobs, and we talk about this often. So those are some of the things we'll get into, Christina, when we talk about the benefits of the infinite banking policy on a child.
Yeah, and it really goes back to your first question, right? What is the goal? And if your goal is to strictly just have money for education savings, for your kid put to the side, then maybe the RESP might be the best route for you. But I do know that a lot of the time people want to set their kids up financially, for life as well. So, and to be fair, we do have clients that are doing a little bit of both, like they're typically doing both and stuff. And now, I would never recommend putting anything above what you're getting for that grant, because then you're really just putting it into the stock market for no reason. Like, get that grant if you feel that that's going to make sense and you know that you want money for university specifically. But if you want to set your child up for life, you're going to want to look at the infinite banking policy for them as well, or instead at the end of the day.
Yeah, well, I wish you were my advisor 20 years ago, instead of me. Um, yeah, again, great for education, but then, what if your child doesn't go to school? So, I've got a child who decided university wasn't for them. I've got a child who has big scholarships and doesn't need a lot of support from the RESP. So what do I do with that RESP now? I mean, that's the challenge that I'm going through now. But just giving people more options. Or, I've got friends whose kids have great part-time jobs or doing a college program where they're making big money on their apprentice, and they're not in a lower tax bracket. So when that money comes out of the RSP and there's tax applicable, it's not at 0% tax like people always think of. Like, it's like, oh, darn, my kid's successful earlier than I thought and they have a good income. Now I got to pay a bunch of tax to get this out. So again, if everything works out perfectly and your child goes to university and for those 18 years you get great returns and everything works out, there's value in that. But we're all about planning for as many options as possible. We don't know what your children are going to do, but why don't we make plans so there's as many options as you could think of under the sun, literally an infinite amount of options that you could use an infinite banking policy for versus an RESP. And then the last thing that Christine, I want to talk about specifically on this is investing in the stock market typically is where people put their RESP. And you think the person's young, but from a risk tolerance standpoint, that person isn't really young is the way we would define risk tolerance. Do you know what I mean?
Yeah, so it's a lot when you're doing the risk tolerance profile and whatnot. It's funny because you mentioned this to me the other day, and I actually thought about it differently than I had previously as well, because the risk tolerance isn't the same for someone going to school. And a lot of people will say, okay, well, when you're investing in your RSP, you can be very aggressive at the beginning. You've got a long time before they go to school. What happens to the, RESPs last year, if you're invested in the market, took a hit, right? Like if your kid's going to school this year, you probably lost a chunk out of that fund in this past year, which is going to impact what the next 4 years look like? And that, I think, is what you're getting at. It's 4 years that we're looking at funding, not a retirement span, right? 4 years is a lot different than 20, 30, 40 years when you're looking at risk tolerance. We've got 4 years where we really need this money. Are they set up to do that in the most efficient way?
Yeah, I mean, if you had $100,000 in the market last year and your kids go to school next year and it's down 30% to 70 grand, well, did you really care about that $500 grant money you got, 2 years ago when you put your last contribution in? Like, people lose sight of the fact that your risk tolerance really has to be tight when you're approaching that university. Some people will say it's like a 61-year-old. You're 4 years away from retirement. You're not going to have the same risk tolerance as a 30-year-old. But I equate it even worse. I think it's like if you're 86 years old and the doctor said, okay, you've got something where you're going to die at 90. So you have a 4-year window left of your life / investing life, and you need to invest accordingly. You're not going to be taking much risk. Well, really, that's really what an RESP is the equivalent of when you're that 16, 17, 18, and it's like, I'm going to spend all of this in the next 2 to 4 years. You're not going to be able to take risks. So sometimes when I see projections out there and advisors, well, we're going to assume a 7, 10% return and stuff. It's like, well, no, you can't. Maybe long term you can get some higher numbers, but you really can't invest that long term, because as you're approaching that university age, 14, 15, you're in that volatility period, or you're in that risk period where if we see volatility, you're not going to be able to recover. If you had another 30 years or 10 years for the market to come back, great. But if it drops when you're ready for school, so really the rates of return, I don't think ever match what they're projected on an RESP.
Yeah, and you've got to take that risk off the table a lot sooner so that you don't lose before in that 4-year target range for school.
Thanks for listening so far. If you're watching on YouTube, make sure you like, subscribe, and hit that bell button so you always know when new content is coming out. If you're listening on your favorite podcast platform, please leave a 5-star rating and leave a review and subscribe. And if you are interested in learning more, please visit our website at controlandcompound.com to sign up for a free education session with one of our wealth coaches.
Okay, Christina, what's next? What are we gonna get into the example yet, or we got a couple more things?
Yeah, I think that we should jump into the example because, we've talked about how this can, the infinite banking policy works versus the RESP. One thing that I want to mention is that you can still use it for school. You can definitely still use the infinite banking policy for school. We're actually going to show you how you can use it for school and a lot more. Now, when we're looking but we promise we're going to show the math. And when we're looking at dollars for dollars, we're going to look at exactly what it looks like putting into an RESP versus putting into a infinite banking policy. We're going to show an example of starting with a newborn, right? So you're, 0 years old, we're going to look at, and we're going to look at putting in $210 a month into each one, right? And that's giving us that $2,500 so that we get that $500 grant each year for those first 14 years. And then that last, $250 in the last. And we're going to incorporate the grants on the RESP side, but we're only going to use the $210 on the infinite banking side, right? Because we're not going to get those grants, but we're going to take a look at these numbers and go through them. So going to bring up my screen here, but for those listening, we'll walk through all these numbers as well with you on the screen. So let's bring up this. And this is just a simple calculator online that I use to find for an RESP. You can get them all on, you Google it, it's online for you. So we're looking at $210 a month. Your child's 0. I'm saying that they're going to school they're starting at age, what did I put there? For 17. So go to school at age 17. Over those years, you had contributions of $45,360. You've gotten your $7,200 in government grants over those years. And now this is using a very conservative return of about 3%, because we're not going to do that stock market where we're going to risk and go up and down and everything else. So just for conservative rates, we've got $17,244 earned in interest over that time period. So in your RESP at age 17, you've got $69,804 for your child to use for education, strictly for education. Because in looking at these numbers, if they're not using it for education, you are giving back this $7,200. You are you can take your 45 back, but you're paying tax. Depending on your tax bracket, you're cutting that $17,000 down. So that's what your RESP is going to look like if you start it from day one and you max out on those grants.
Okay, so if you do full RESP, you're looking at 69 or just about $70,000. But if your child doesn't go to school, you're paying tax on the 17, so let's say $8,000 there, and you're repaying the government grants of 7,200. So you're like, could be like $16,000 that you'd have to repay or pay tax on or repay of this roughly $70,000. So again, huge penalty if the child doesn't go to university or college.
Yes, exactly. So that's what our RESP looks like. So now we're going to take a look at an infinite banking policy that we're going to show here. So again, same parameters. We're putting in that, 25-20 is what we have going into it, just to match the same as the one above. We're setting it up to maximize it for our infinite banking. We always want to make sure our cash values are most efficient in the setup when we do it. But let's look at the actual numbers, because that's what we're here to talk about today. Okay, so, and this is just at one of the companies that we work with, right? So they're going to look pretty similar, but just an example for us. So at age 17, what do we got? We've got $51,000. It's not the 70, no, but if you took the money out, it's probably around the same, right, in cash value. So it's not far off. We're not talking a huge mass amount in difference there with this policy, right? So, but what you're also seeing over here is a $479,000 death benefit as well. So we've got a death benefit there. And this is one thing I want to bring up as we're talking about one of the benefits of the infinite banking policy is insurability. That death benefit's huge, right? So, when a kid's 0, they typically have 0 health problems. They're very healthy individuals at that point in time. But when you get older as an adult, you can develop health problems, which can stop you from getting life insurance. The day you put this infinite banking policy in place for your kid is the day you protect their insurability for life, because they now have a life insurance policy for the rest of their life. You've locked that in for them. So I did want to bring up that point on here.
Yeah, I love that. There's all kinds of kids we know that are not insurable, and forget about infinite banking and all that stuff, but just protecting your family. Great. Well, if you're uninsurable, you still often want to grow up and get married and have kids and have a productive life, and knowing that my child for sure is going to have a death benefit regardless of their health in the future to protect their family. That's huge. What are also some of the key differences?
Okay, so at this point in time, we are going to, we're going to school. So like I said, we can still use it for school. But what's happening here as we're in school? So we've taken our unstructured policy loan, right? We're able to take the policy loan to be able to use each year for our school. But as we're in school, you can see we're actually going up. So now we've stopped making deposits. We're not making any more deposits. In this scenario, we're going to look at another one, but we stopped making deposits. We've gone from 51 to 53 to 55, 58. This is still growing. What's happening in the RESP, Darren, as we are using it for school?
We smashed that snowball down to nothing.
Yeah, that is the saver, right? We talk about it. That's the saver. They've saved, they pay cash, and now they have stopped their uninterrupted compounding. They are no longer growing. With this, your cash value grows the exact same whether you have a loan or you don't have a loan. And that's going to happen for, your children while they're in school as well. Now, as we're saying this, I'm sure people are thinking, but I've taken a loan. Like, what am I, why would I want to take a loan that has to be repaid on this policy? Why would you want to repay that loan, Darren?
Well, let's see. If I repay the loan and now all of a sudden I have $70 or $80 or $90,000 in there by repaying that loan, I've got a 20-year head start on that compound interest curve. I'm not going back to zero. I'm already 20 years into that. And when you see the benefits of what it can do for you for the rest of your life, it's the reality is people are going to need to save somewhere, and this would be the perfect place to start saving, and you get a 20-year jump start.
Yeah. And well, whether they're saving or you're still saving for them, and or they want to be the debtor, maybe your plan is to teach your child that they are going to pay for their own education. And people want to do that because you appreciate your education more when you pay for it yourself. So maybe as the parent that has set up this policy, who are the bank, they are the bank, right? So very easily they can set up a nice loan program for their kid where they're able to pay it back. And now they're 30 years old and we have that $90,000 and it's time for us to get our first home. We now want a deposit. We want a down payment for our first house. Well, we've got 90% of 89,000 that we can now take for a policy loan for our first house. From this exact same amount that we were going to save for education anyways, we now have a down payment for a property that we can use for that child.
So we paid for the school in this example, and we used an $80,000 loan for a down payment on the first home. Not one thing, and.
And asset. And let's keep scrolling because this is for life. This is not going anywhere, right? So let's say we have taught, now this is a very important piece. We have taught our children the importance of uninterrupted compounding. We have had them read Be the Bank. We've made sure that they know what what this is all about. And they say, okay, perfect. I'm taking my down payment for my real estate, but my plan is to repay that loan. Okay, so I'm going to repay that loan and now I'm 40 and I want to start I'm starting my own business. I have a great idea. Well, I've got 150,000 in cash values now from repaying that loan that I can now go and take that loan and I can do a business, right? So this money is still compounding. This is all the same funds that you have put to the side for your child for university, has now purchased their first home for them, gave them the opportunity to be able to do it with that cash there. And they've been able to open a business. Now, lots of things could have been happening in between time. Maybe they needed a roof on their house and they had to take some out and pay it back. But we've taught them that they have to repay these loans for this to work. Because if we keep scrolling down, they've now hit retirement and they have 565,000 inside of this policy, right? They've got 565 for retirement and a $1.1 million death benefit at age 65. That's huge, right? Like this is all from your investment in their education. This is lifelong. This is a lifelong strategy for your kids. And then it also includes, and maybe you want to talk about this a bit, Darren, but a generational wealth transfer. You talked about those grandkids earlier. You're closer to grandkids than me. So I'll let you do this one.
Let's not hope too close. And we're going to show you a second illustration because actually, let's wait till the second illustration, Christina, because this is the one that we're trying to do an apples to apples comparison. I'll be honest, we would never present this in this format to a client without the second piece. Yeah. And the second piece is, Christina, you talked about teaching our kids, and it's something now brainwashing. Some people think it's a bad thing, but it's teaching your children how to save money consistently, how to stay on that compound interest curve. So right across almost every single child's policy we're ever going to do, we want as many options as possible. So Christina, are we going to stop that $2,500 premium now that the child's 24 years old and they're out working, getting a good job from all the great education we have?
Absolutely not. So we set them up so that they can make these deposits into their savings accounts for the rest of their lives. And like I said, I want to do apples to apples. I did promise the math on exactly what you would do in an RESP because there's nobody that's depositing in an RESP after 17. It's just not going down, right? So that was apples to apples. This is lifetime. So after 17, we both have these policies for our kids as well. After 17, my plan is he's not at that education years yet, but this is going to continue. This is $200 a month, like $200 a month that I have to make sure he understands that before I hand this off, he knows he's got to save $200 a month into this policy. And the reason for that is because this is the best bank account he will ever have for the rest of his life. He will never have a better bank account again. So he needs to be smart enough to use it.
Okay, so continuing that $200 a month. Now we're still going to have the same for university because in the first example we paid up to the university, but now at age 30, instead of having 90% of 90,000, it's 90% of 131. All right, yep. So now we're talking over $100,000 available to 100 plus to buy that first home. And then if we scroll down to age 40, Christina, how are we doing at age 40?
A little over 250,000 for that business they want to start.
Well,
So
you got 200,000 plus you could borrow to start that business, buy the first rental property or the second or third or fourth rental property. And now the numbers get silly when we look out long term because we're on that exponential growth curve. We're rolling that snowball. We get out to age 70 here, there's $1.4 million in there, $2.4 million of death benefit. We get to age 90, it's $3.4 million of cash value, $4 million of death benefit. If we go all the way to 100, we're up to 5 million plus. So let's just kind of think of what this policy could do versus an RESP. All right, so if I had done if again, I have children's policies, but I wish I'd started them when they were younger. What could I have done with that? Well, remember, you set up a kids policy, you own it, you control it, you pay it, you're the beneficiary, you make all the decisions. So one of the things you can do with your child's infinite banking policy, because you're the owner, well, you can access money anytime you want for you. So let's say you run into financial trouble, you need money, or you see an amazing opportunity, or maybe you just want to do something like private lending. So you get 50,000 in your kids' policy, and you go, you know what? Why don't I borrow 50,000? I'll go to a private lend at 15 or 16%, pay the interest, net 10%. So before tax, so you get 10%. So you're making $5,000 a year on your kids' policies, and it doesn't affect the growth of your child's policies whatsoever. So you can access this over and over again while you own it and while the child owns it. We're showing you 18, 30, and 40. But at any point, you can say, you know what? Why don't I do a nice quick private lend? Or why don't I do this great opportunity? Why don't I do a flip? Why don't I do a burr? Whatever you need money for, this is, until you hand it to your children, this is your bank. So you can make all the decisions. Now let's talk, Christina, we mentioned intergenerationally. What this policy does is it not just helps your kids, but it helps your future grandkids, because the person that's going to benefit from the cash value is your child, right? They're going to be able to, well, you initially for the first 20 plus years, then you hand it over to your child. And in Canada, we got very beautiful tax laws that say when you hand this over to your child, assign the ownership to your children, how much tax do you have to pay, Christina?
Zero.
So we can transfer this with all the growth tax-free to the child. So now they own it and they're making the contributions. But let's talk about cash value. They're going to benefit from the cash value, but we talked growing eventually to a $3, $4, $5 million death benefit. Who's going to benefit from the death benefit, Christina?
Your grandkids. So that's going to be the generational wealth transfer, right? You've set up your grandkids for success as well. And we see a lot of individuals that aren't leaving it there. They're actually setting these up on their grandkids when they're born. And now you've completed an entirely next set of generation. You're looking at your great grandkids at that point. And if you teach your kids right, they're going to do the exact same thing, and they're going to set it up on their grandkids. And this is just going to be a never-ending generational wealth transfer system that you have set up. You've set up a banking system for your family, right?
Yeah, and I mean, like, literally, there's infinite things you can do with it. I know some parents will look to recoup the deposits they made for those first 15 or 20 years from the child at some point down the road via a policy loan, and the child pays it back. Again, you can do basically anything you want with it, but it's guaranteed not to go backwards. We compound for 100 years instead of a short period of time for the school. You can use it, you control it, and let's hope this doesn't happen. Let's say your child goes sideways and starts making life choices you're not comfortable with and you don't want to support financially. Well, you don't have to hand that policy over to your child. You're the owner. You can use it yourself. You can keep it till you die. You can cash it out. You can borrow against it. You are in control. So you have that option to say, you know what, I'm not going to support you financially in this endeavor, but maybe I'll keep it. And at another point, you can do this, and you don't run into those age restrictions like an RESP has to be used by a certain time. So parents can use it. Kids are going to benefit multiple times, and literally, you're setting your kids up for 100-year run on the compound interest curve, or hopefully 100 plus years. That is going to, even at that $200 a month, we're talking about $3, $4, $5 million long-term, tax-free retirement for the kids, ability to buy a house, rental property, pay for university, ability for the parents to benefit, death benefit for your future grandkids, death benefit if your child becomes uninsurable, you're guaranteed a death benefit long term. I mean, the advantages go on and on, Christina. What else did I miss here?
One thing that I like to talk about is the ability, one of the companies that we work with, we typically use when we're setting up children's policies, is the ability to make up missed deposits. So maybe in that first example, you do stop making the deposits at age 17. That was your plan. You don't want to fund it anymore. And then 10 years later, your child has a great career. They're all set up, ready to go. They can actually turn around and they can fund those missed years for the last 10 years, right? So they can top this all back up and have it exactly, maximized just as we want it to be, which is huge, right? That is what we call planning for windfalls, is what you call it. And a career would be a windfall and cash coming in, but another one would be an inheritance, right? So typically, if a kid has one of these, the parent has one too. Always. I don't think I know anybody that doesn't have one, that they have it for their kid. You always set yours up first, and then you set up your kid's policy. But at some point, your kid's going to, no matter what, you could try to spend all your death benefit, but there's still going to be something there for your children. And having a place where they can park that money is going to be very beneficial as well, because we see what these do. Kids have so much time on their hands, right? When you look at these things, that snowball for a child is huge. The growth that they see in those later years, it's a no-brainer. You look at it and say, oh, I put 2,500 in and I'm going to go up by 50 grand this year. I think I'm going to do that, right? Like, I think that's a no-brainer at that point in time. So setting up long-term.
I love that, planning for windfalls. We can talk about our situations, because we have policies ourselves and we have policies on our kids. But let's say, your child's 40 or 45 years old and you're old and you pass away. Well, what if the child had a $200,000 outstanding loan because they just went and bought a 12 unit? Or what if they're in debt to pay for their kids' university? Or what if they took a loan out for just about anything, and all of a sudden this windfall comes in from the parents' infinite banking policy? Well, where do I park that money? Well, we plan for this. We got a windfall that we can put in there. And Christina, like you talked about it, but I can't emphasize enough how incredible in the insurance world that you can literally take 10 years off payment. So let's say your kid's in the 20s and they're like, mom and dad didn't know what they were talking about. This is stupid. I'm not going to save in here. And all of a sudden, 10 years later, they're like, mom and dad, not that dumb after all. Maybe this was a good idea. Well, not only can they resume contributions, but the ability to go back and make up those contributions. I wish right now I could go back 10 years on my compound interest curve and say, hey, can I start compounding 10 years ago? And that is just incredibly. So what I love is, instead of helping your child for a limited opportunity, university and college predominantly, whether they go or not, you can help your child financially for the next 100+ years. You can help your grandkids, and you can help yourself, because again, you own this policy until you decide to gift it to your kids. It just does so much more. If the university, you got a slightly less amount for the child, but it helps them for the next 80 years after university. Oh my God. For me, it's a no-brainer, Christina. What if I go back in time? It would have been only the infinite banking policies, a $500 grant in a volatile stock market that could drop $500 in 20 seconds on the stock market. So, for me, it's just real simple. An RESP is fine. An infinite banking policy in a child is infinitely better.
Absolutely.
All right. Is that a wrap, Christina? Anything else before we go?
No, I think we touched on everything we wanted today. The RESP versus the whole life. Come back to that question: what is our goal? Do we want to save education, or do we want to save for life? And I think we've kind of gave you the information and the tools that you need to make that decision.
Love it. Okay. Thank you for the listeners for reaching out and telling us what you want to hear. Please, in the comments below, can you just make some suggestions if there's a topic you want to talk about? And we'll try to bring it on a future podcast. Thanks for watching. Thanks for listening. Thanks for listening to this podcast. If you're listening on YouTube, please like, subscribe, and hit that bell button. If you're listening on your favorite podcast platform, please leave us a 5-star review and subscribe. And if you want more information, check out our website, controllandcompound.com, and you can sign up for an education session with one of our wealth coaches.